traders do tend to overlook the psychological aspect of trading and believe it's all about just the strategy, the strategy, the strategy, and that holy grail. But the strategy itself is simple, but the psychology of it, that's the hard part. Most traders will have dreams about one day quitting their jobs and making this a full-time business, trading the foreign exchange market. Now, there's actually a saying, it's almost never the strategy, but always almost you, which means you and a friend could be using the very same strategy that I teach or the strategy that somebody else teaches. One will be making very good money from it, and the other one may find some way or the other in losing that money using the very same strategy. So trading is not complicated, but it is difficult because of the psychology, because of the mental side of it. And most do actually underestimate it. I mean, it doesn't take a long time for you to actually learn the basic aspect of trading. Um, Buy low, sell high, that type of thing. It's not hard, but many will actually fail to be successful because they fail to control their emotions and fail to think about the psychological aspect of it when it comes to trading. Now, before we get into the charts, I want to go through just a little bit of type of emotion that a trader can experience. What type of mindset you need to have and what type of mindset you need to avoid to become a successful trader. The psychological aspect of trading is the tough part. Believe me, I have been there. I've been doing this for 12 years, and the first few years were pretty much an emotional wreck. Lost money, made money, lost money, made money, but it was never consistent. And even when I believe I had the Holy Grail strategy, there were still a few emotions that really got to me, which was mainly the fear and the greed of it. So before I go, I want to mention one thing. The traders I spoke to mainly in the forex market, but the wisdom that I have in this webinar can be applied to the market, the stock market, the equity market, commodities, and so forth. So it's not just geared towards forex, but geared towards any other financial market that we can trade. So one of those emotions that I want to get into is fear, and fear is probably the most crippling emotion a trader can actually experience. It will ruin you big time. Fear is actually being scared to place a trade. Even if though those criteria meet, your market condition meet those criteria, and everything is set to go buy or sell, but because of that fear, you're unable to press that trigger. Highs when you're winning a trade, and you have a horrible sinking feeling in your stomach when it goes against you. Fear is actually when you lie awake at night hoping, praying, keeping your fingers crossed that you don't get stopped out. It's when you ruin your health with stress because you know you absolutely cannot afford to lose this money. And this is why we always say in trading, risk, invest what you can afford to lose. So if you can throw away $10,000 without thinking about it, invest $10,000. But if that $10,000 is going to be there for college fund or rent or mortgage, don't trade it because that's where your emotion is going to take a toll on you. The next thing I want to get into is the greed aspect of it. Now, greed is not an emotion that I personally have. I think I've taken care of that over the years, but it's an emotion that has been the downfall of many traders. And it usually manifests itself once a trade has been placed and is nicely in profit. No matter how profit has been made, for some traders, it's never enough. They always want one more pip, 5 more pips, 10 more pips. It's never enough. And this is why I've always said when we actually enter a trade, we go with a trading plan. So if we're trading a 2-to-1 risk ratio, then that's what we're trading. And once we get that profit target, we close the trade. And if the trade goes in more in our favor, so be it. We're not greedy. So always have a trading plan. So once we can control the fear and once we can control the greed, we're ahead of the game. So with that said, I want to get some more. I want to get into going into some live charts and going through a few examples. And for those who are new to forex trading, this might be a little bit more advanced, but at the same time, we can always ask questions. And what I'm going to do is actually break down a few charts into pieces so you get an idea of the mindset behind each and every trade as we go along. So the first pair we're going to look at is we're going to look at the Garnet pattern. We're going to look at the Garnet pattern, which is a very powerful pattern in the market, but it's also difficult to see with the naked eye, and especially for a new trader, it's extremely difficult. But it's a pattern that can literally give you anywhere between a 3-to-1 or 5-to-1 win ratio. Now, what the Garnet pattern is it's an ABC move within a larger swing point. So within this AB move, we have a ABC move within this range. So what usually tend to happen is this, and I hope everybody can see the chart clearly. Let me magnify this a little bit more. Okay, so here we have the I believe this is the euro dollar. I believe this is a euro dollar. So what we have the market actually ranging at this point. So as the market ranges between the resistance and the support point, eventually we get that breakout. And one of the good things when we see consolidation periods in the market is that it always follows by a good breakout because of the momentum. Because within these areas are getting filled with buyers and sellers trying to dominate the market and trying to push the market outside of that range. So this area becomes filled with momentum. And at some point, we're going to get that breakout either to the south or to the north. What will tend to happen on most occasions is that if the dominant trend is down or bearish, then most likely we're going to get a continuation of that bearish move in the market. So that breakout is going to be to the downside. So here we had some level of consolidation in the market as the market hovered along support area. Now, one of the few things that we look at when we're looking at this consolidation period is one, how often has this area been compromised or breached? And we can see that the market came down to this level and broke through barely, which means this is actually a false breakout. So the market came down, bulls pushed the market downwards, and bears pushed the market downwards, and the bulls pushed the market all the way back up to this point. Now, here we had some exhaustion in the market because the bulls were unable to sustain the momentum to keep the market going upwards. However, there was not enough selling pressure to push the market further down. So the market went sideways, came down again, and here it actually formed what we call a pin bar. Now, what this pin bar signifies again is exhaustion in the market because sellers pushed the market all the way down to this level to support line, and the bulls pushed the market further back up. So this candle represents or is indicating to us that the market is exhausted and bulls are now in charge of the market. Then we have this bullish confirmation candle. We're saying, okay, you're bulls, we are in charge. And then we have that small breakout, brief breakout here, mark reverse, fill this gap, because again, what will always happen, what will tend to happen with the market is that it tends to fill the gaps within the market itself. So when we have a price surge, such as this candle, very unlikely the market is going to continue upwards. And if it does continue upwards, at some point, this area is going to get filled. So we had a price surge here, maybe because of a news release or just influx of buyers in the market. But we had a price surge here based on the size of the candle. We had a price surge here. And as price surged, we have buyers taking profit, and so the market has become weak. So the market dried up at this point. So it's not necessarily that we have a lot of sellers at this point. It just means that the bulls or the buyers took profit at this area, so the market is now drying up. And once the market starts drying up and gets weak, we're going to get that retracement back into the gap. So this gap is filled because of exhaustion in the market. Now we had some level of consolidation here again, and then for the next 2 days, we had this nice huge breakout with an uptrend. Now, as the market trends upwards, this is a strong uptrend because here we have each gap pretty much being filled. So we have a lot of buyers and sellers in the market at this point, but at the same time, bulls were clearly in charge of the market as the market kept making higher highs and higher lows. So the market got all the way to this point, which created this A-B swing. Now, once it created this A-B swing, we're expecting at some point the market to retrace. Once the market retraces, bulls are actually looking to get in at a better price in the market. Now, there are other things that we look at during my one-on-one coaching session. There are other things that we go into which can identify a full trend reversal or pretty much identify just a brief retracement in the market. So here we had this A-B swing, and then we had this small retracement in the market, and it came back to a support line. Now on the chart itself, there's no support here. There's no support area at this area, within this area. But further to the left, we'll find support. So the market came back down and hit support here. Now, one of the things that indicated to me that the market is going to continue downwards is that it broke this low here. So the market came up and then it retraced briefly. Then the market made a new high. Once the market made this new high, the market plummeted and broke this low here. So once it breaks this low here, again, we're expecting this gap to be filled. And then I'm expecting a more bearish move in the market. So the market came down, acted on support, and at the same time, I'm expecting now a retest of this high. So the market came down, then the market started rallying up, created what we call this pin bar again. And again, this is where bulls were in charge of the market, pushed the market upwards, and then the bears pushed the market down. So here we saw exhaustion in the market. Then we realized it created this other high. Again, the market was not able to break this high or even this high, so we are expecting a fall. So what I did, or what I did initially was waited for this fall. So I actually didn't trade this pair just yet. When the market got down to this area, this is when I realized there's a possibility that the market is going to continue upwards, because as I said, based on this AB move, we have an ABC swing in the market. So on this swing point, D, this is where I would be entering the market to go long. And this is what we have to put our mind or put ourselves in the mind of other traders. So Let's say from this A point, I got in here. I took the market all the way to this point. I'm banking profits. So once I bank profit, what's going to happen is that there's going to become a weakness in the market. And this goes for 90% of traders. They're going to take their profit off the table once they get their profit, once they get the market to this area. Then we're going to be looking for other areas to enter the market. So again, we could have entered on the support line at this point. Market rallied and then it fell. What happens now? It got back to origin of this AB swing, almost to the original point of this AB swing, which initially there was an influx of buyers. So what's going to happen now is that buyers see this fall in the market and they're going to take advantage and say, okay, if the market is going to continue upwards, then there is no way it is going to break this low point. So we're going to enter on this 78.2 retracement of this AB swing. So on this AB swing, we had a move all the way 78% of this swing. We enter here on this swing at this point. We enter here, and then our stop loss is below this A point, because we always try to put our stop losses above or below where the market has not traded for a period of time. So once we can put our stop loss away from the market, it gives us a better profit potential, so the market can play itself out. Because what will happen, there are times the market will dip further down, equaling this A point, and then rallies. So we got in on this D move as the market fell. We got in on this D move, and then what happened next? The market rallied. So market came down, and if you notice, the market actually fell a little bit more. Market came down, rallied a little bit, just a bit, came back down, created what we now call a double bottom. So we had this bottom equaling this bottom at this point. So again, it more puts the odds in our favor that the market is going to continue upwards. So we got in at this point with our stop loss below this A, and within the next over the next 24 hours, the market rallied. Now, as the market rallied, what we did, we used our stop loss and we trailed the market. So we trailed the market all the way to this point, and then we got stopped out here as the market retraced. So on this move alone, we had at least 150, if my memory serves me correctly, at least 150 pip move within a 1-day period based on just identifying this pattern, which is called the Garnet. And once we can identify this pattern, and once we can predict where the market is going, it gives us a better trading opportunities, and it puts the odds in our favor. Now, shortly after that, and this is the euro dollar, shortly after that, there was another trade with the Garnet again. Let's see if I can find it. Okay, here we go. That's not it. It's always sucks when you're trying to find something and can't find it. All right, we'll leave that for the time being. Next, we have more recent trades. We have the pound Aussie. Now, the pound Aussie it pretty much almost was identical to the pattern that we just looked into, the Gartley. So same with the Aussie. The Aussie was trending upwards. then it dropped, it dipped back to support point, then the market rallied again. Now, as the market rallied, the market retraced and leaving these two pin bars at the top. Let me find a better trade. Get rid of this. Okay, here we go. Now this pattern is called the head and shoulder pattern. So the market rallied, created a peak here. Then the market dipped into the valley, and then it rallied again, creating this high. Now, once the market created this high, the market retraced. So again, bulls took charge of the market. Market became exhausted. Bulls got back into the market at this point. Market rallied. Market got exhausted. Bears took charge at this point, which was a support area. Sorry, which was a resistance area. And then the market fell, equaling or just going just below this low at this point. Once the market got to this point, it actually created another rally point, which I believed the market would have actually created some sort of bearish signal here for the market to dip. So what we did, we actually waited for the market to rally somewhere within this area, and I wanted to get the market closer to this point where I was able to enter with a tighter stop, placing my stop loss above this high. So yesterday or last night, the market actually went up, rallied to this point, and on the very next few hours, the market actually fell. So we had the left shoulder, which was created, the head, which was created, the right shoulder. At this point, the market actually went up to this area, acted on the resistance line. The stop loss was above this high, and then the market dipped drastically. And this was based on a news release last night with I think in Australia. It was a rate decision that came out around 10 o'clock, I believe, and the market fell. Now, this is a prime example where there are times the price is actually factored, the news is actually factored into the price itself. So a lot of times you have people that are traders that are focusing on the fundamentals. What's going to happen in the speech? What type of news release? What kind of data is coming out? And many times that data is actually factored within the price itself. So I really didn't need to see or know what was going to happen in Australia to know that the market was going to fall. Based on this pattern, based on technical analysis, I was able to determine the market was going to hold along this area, and then the market would fail eventually. What I didn't expect was this quick move, because this entire move was over 250 pips. So within a 3-hour period, using a standard account with one lot, we could have made over $2,000 on this one trade, and we're out. For many, that's salary for the month. For us traders, that can be salary for a day or two. So this goes to show the high potential of trading patterns in the market. And patterns are sometimes overlooked because, one, they are not formed very frequently. And so as traders, we always tend to want to be in the market. So we tend not to wait on these patterns. But think about it. If we trade one of these patterns once per week, that's 4 times. And of the 4, let's say we have a 50-50 win ratio. So we win 2, we actually lose 2. With a risk reward average of say 3 to 1. Wouldn't it be easier to trade these 4 patterns for the entire month and walk away with say 10-15% versus trading on a daily basis with wins, losses, wins, losses, wins, losses, and at the same time playing with your emotions. So it's actually you're on this roller coaster ride with your emotion, trying to make a profit, trying to make a profit. But instead, if we can wait until a setup is formed, until the market says sell me or buy me, it puts the odds a lot in our favor. Because when we trade erratically, when we trade random, it's just as much as us going to Vegas and throwing our money on the roulette table. It's gambling. So once we can identify these patterns, once we can trade these patterns, it puts the odds a lot in our favor. The next pair I want to look at is the Aussie dollar. Now, the Aussie dollar has been a favorite of mine recently. Before, it's not something that I really traded, but it has become very somewhat volatile over the past few months, and it has offered some good trading potential in recent times. Now, breaking down this chart, we have at this point we have areas of consolidation in the market. It was a wide range, and within this consolidation period, traders could actually make money by selling the high or selling resistance, buying support, selling resistance, buying support. So the market actually consolidated or was ranging for a period of time since, say, the 18th of February all the way to the 24th of February. Then we had this breakout. So we had this breakout in the market, and as I mentioned before, what will tend to happen is that once we get that breakout, the market tends to want to fill that gap. So we had this breakout, we had this retest, this slight retest in the market, and then the market rallied. I didn't trade this. I think I wasn't at my computer at the time when this happened, but I got in here at this point. So the market went up, created a top, which is now resistance. Then the market fell to support. Now, once it fell back to support, ideally, this area is a strong level of support. Why? Because one, it took a strong candle to break through this level. That's the first thing I'm looking at. It took a strong candle to break through this level. Secondly, looking back to the left, we realized that the market held along this area for quite some time. And going further back in the past, this market actually held for a very good period of time in the market. So this line in the past acted as support at some point, and it acted as resistance. So in the future, we're expecting this line to still hold the same. If we're wrong, hence the use of our stop losses when we are in. Not that we are wrong, but the market will do what it wants when it wants. So the best thing for us to do is secure our investment by placing stop losses, because there are times when we're going to be wrong. So market went up, created this high, and then the market fell. Now as the market fell, it created this pin bar. And what again this is saying to me is that the market came down with the sellers, market got exhausted, and the bulls pushed the market all the way back up. So as the market pushed back up, this is saying to me this area is now has now become a much more stronger area of support in the market, because the bears were unable to break this area and close below it, below the line. Bulls took the market up and created this bullish candle, which would also be considered a bullish engulfing candle. And again, this is discussed with my one-on-one training session, going into patterns and candlestick formations and the various different type of candlestick formations that will appear at a resistance point or a support point. So we place our trade on the pullback to now support, and then we place our trade at this point. What happened next? On this pin bar, the market rallied again back to resistance where there was a take profit, and then the market fell. So on this move again, and these are simple trades, because what we tend to do, we tend to overcomplicate things. And because of the lack of patience that a lot of us do have in the market, we tend to overtrade, we overcompensate, and we overcomplicate. And this was clearly an easy trade based on just reading the candles and what the market is telling you. One, the market is saying this area is a strong level of support or resistance at this time. Market came down, came back up, broke through. It took momentum, it took force to actually break this level in the market. Market went up, created a high at this point, and then created resistance along this level. Market fell back to support point. Now, as the market fell back to support point, it fell back to the origin of where the bulls or the buyers were in the market when they took charge of the market. What happens? As buyers getting in here, exiting here, we got back in at the source again. Getting in back at the source, we were able to make at least another 100 pip run on this trade. And if we're trading resistance, we could have sold it here and profited at this level. So it's not hard. And as I said in the beginning, your emotions, the psychological aspect of trading is the main part of being successful. That is the key of being successful, not the strategy itself. Because once we can identify a strategy and make it simple and make it our own, the rest is easy. The market will make you money based on your money management, and based on you being able to control your emotion, being patient, and reading the market as it goes along. So we're not basing the trade on, I wonder if. We're not basing the trade on, I believe it's doing this or I believe it's doing that. Because most traders, once they see a drop like this, they're going to go short because they've seen this candle, actually see this candle as a powerful bear candle. And so they're going to go short on it, not realizing that going short, we're at a support point right here. And once we're at support point and seeing that the market actually held support at this area, there's a possibility where the odds are in our favor that is going to hold along this area also. So we need to read what the market is telling us, because many times the market is saying to us buy or sell or just stay away. Simple as that. What we're going to do, go to some live charts, and right now we're at the Euro USD dollar, and we had a strong decline in the currency pair a few days ago. Market rallied, acting on resistance, came down, broke this low at this point. Market came back up within the range, and there's some level of consolidation. Now, for me, looking at this pair, I would be hesitant in actually trading this pair. Reason being, we have a strong decline in the market. Market held support here. Market came back up and rallied, held at resistance. Market came down, broke the support point here. So this is actually a false breakout. Went back into the range and then acted on resistance again. Market fell, acting on support, and then the market declined, creating another false breakout in the market. And now the market is back within the range. So there is no defined direction in this market right at this point. One could say, okay, I'm trading it to go long because it actually went back in the range. So based on these past movements, the market should get back to this area or to this level where we should find another bearish formation candle, or the possibility that it might break out. We don't know, but I'm not going to base my trades on guessing games. I'm not going to base my trades on the fact that, okay, I believe this. I have to wait until the market says to me, I'm ready to move forward or ready to go up. Now, where I would trade this is if within the next few hours, this level actually still holds and creates a bullish formation candle. So we might get a bearish pin, a pin bar, a breakout in the market, and a pullback. Once we get that breakout and a pullback, then I can actually believe that the market has the potential of pushing forward or rallying. The next thing I will look at is my MACD. Now, the MACD for some, it's used in different ways. Some people will use it, or some traders will use the MACD as a divergence, while others will use it as momentum. I use it more for momentum trade. So what I'm looking for is for the market or for the MACD to show me momentum in the market. So the market, this MACD needs to show me that there's momentum to push the market further up. What this is saying to me right now is that we're going to have sideways movements. I could be wrong in my analysis, but this is what I believe the market is saying to me. We're going to have sideways movements, so I'm staying out of the market at this point. And these are the things that we need to incorporate in our trading on a daily basis. Know when to hold, know when to fold, know when to walk away. And that, on many occasions, will keep us away from losses. Because walking away from a trade and not trading it is still trading, because it's actually a decision that we've made to not enter the market based on your criteria, based on the fact that the market is choppy. So once we get this type of movement in the market, for me personally, I'd walk away. Even though it is saying, okay, we are back in range and there's a possibility that it may continue upwards, the market is actually filling this gap at the moment. But again, it's just my take on what I'm reading in the market. For another person, they might read something totally differently. And not saying that they're wrong, because we all have our own perception of the market. We all have our own analysis and our own opinions of the market and what the market is doing. The main key is sticking with your analysis, and if you enter a trade, you enter on logics. You're not entering on hope or keeping your fingers crossed, hoping that the market's going to go up or hoping the market's going to go down. We base it on technical analysis. We base it on what we're seeing. So whatever you perceive the market to be doing, then you trade along that line. And then when it comes to stop loss, traders will not use stop loss because, again, they are hoping that the market will turn in their direction and they have the fear of losses. But it's best to walk away from a trade. Market stops you out with 10 pips or 20 pips. You're able to trade another day. Once you keep that trade open without a stop loss, then that's when your emotion starts to ride. And that's when you're going to be hoping and praying, hoping that the market turns and goes in your direction, keeping your fingers crossed, and then you'll only see your account depleting, depleting, and depleting. So, with that said, finally, plan your trade and trade your plan. Have strict money management rules, have strict criteria, have discipline, and once we can couple those with our trading, then we are 50% ahead of the game. And then eventually you'll be part of that 5% or 10% of traders who are actually successful in trading. Because it's not a hard game, it's not a hard business. But once we are able to home in on the fundamentals of the trade, home in on reading the candles, knowing a little bit about the fundamentals, then the odds are always going to be in our favor. And having that 3-to-1 or 2-to-1 risk reward ratio to our advantage is always key. So before I go, the last thing I want to say is plan your trade, trade your plan effectively, and you will succeed. Is there any questions?
None from me, Ray.
All right. Well, everybody seems to be okay so far. Um, Well, I hope it's clear, and I know that for some, I may have jumped the gun a bit because I went more into the technical aspect of it instead of the fundamentals of the Forex market, like what is Forex, what drives the market. But these are done in my group, in my one-on-one sessions. So for those who are new or who are new here, you know, I've tried not to go too much into the advanced section of it. And hopefully we all learned something from this today and we can go out and say, okay, let's trade our demo accounts and try and make some money eventually, go into live and definitely start making some money. So with that, thank you all for joining in and I'll speak to some of you soon.
All right, Ryan.
All right, take care.
All right, take it easy.
All right, bye bye.